我好像 All right, let's get started. Good evening, everyone. Welcome to our CAPA Nova events. 欢迎大家来到我们 CAPA Nova 平台。今天呢，是我们1个月一次的Financial Literacy 系列讲座节目。Before we get started, I just want to take 1 minute real quick, introduce CAPA Nova. 在介绍今天的麦克教官之前呢，我们先花1分钟时间快快的说一下 CAPA Nova。CAPA Nova stands for Chinese American Parents Association of Northern Virginia， 中文是北维华裔家长协会。我们始建于2021年，在过去的这个4年多的时间里头，我们已经为华府社区做了上千场各种各样话题的公益讲座。其中呢，这个 Financial Literacy 是一个我们的保留节目。今年呢还是一样哈，那个1个月一次希望大家关注麦克教官的这个税务讲座。麦克教官呢是我们华府非常非常可以说是现在是那个知名的 CPA 他在他的头衔下呢已经有好多就是刚进来的请自己 mute 一下自己哈。他呢还是 CFA、CFP 那个 FRM、SCR 还是 enrolled 那个 RS enrolled agent 那个 anyway。那个 for those who don't know, Coach Mike, you are here for a eye-opening experience. His class is always filled with insights and his knowledge on the different subjects are very comprehensive. It's just not, simply related to the tax only. So without any further ado, I'm going to give the stage to Coach Mike. And tonight, the subject is about 10 takeaways from the 2024 tax season. All right, Coach, stage is yours.
All right, thank you, CAPA. Really happy to bring my observations and perspective to the platform. I think just like every sport, every skill set, you always do a self-reflection, right? When I finish this season, I want to think, what a lesson I learned from this 2024 tax season? How can I be smarter next time as a tax professional? It applies to everybody, right? If you cannot repeat the same mistake year by year without knowing that. So every year, sit down with the family, with your family board advisors, sit down. What can we do better to optimize our deductions, have better record keeping? So do a little bit sit down, do a self-reflective discussion, and try to bring family together, talk about strategies, always do this kind of talk. So next year, less painful, right? Less torturous and more effective. So I really hope the team, the family can do that for your future. All right, for my self-reflection, I want to say this is personal view, does not represent any commissioner, employer, or other staff. I'm not a licensed stockbroker or life insurance broker or crypto. If you want to do all these things, talk with the professionals. I only give you tax advice. All right. I come up with 10 observations from the takeaways, and also I designed about a dozen situations I wanted you to think. At least based on my observation, I can go through that. But the case studies, I want Ted, Carrie, you guys can comment in, and Fred, all the people I'll call out names. And you think what should be the right? These are real-time examples. I want to see what do you think. How do you deal with that? All right. So first takeaway and record keeping. Yes, when I do your tax returns, you give me your numbers, how much meals, travel, and how many gifts you give out. I don't see every record because this is your job. So for tax accountant, I take in. My role is give you assessment. Let's say if you are a real estate agent, you deduct $500 for gifts. That's reasonable because you have to buy some gift card for your clients. You have to go to certain parties to bring a bottle of wine or some flowers, chocolate. It's all good. But if you do a lot of expenses are excessive, I'll give you a warning. Say this may not be a good idea. So my role is give you the high level. I call it due diligence, but your job is record keeping, right? So make sure you keep all the things in a good order, especially the miles, right? The receipt for purchase. And I use the Mile IQ. It's an app you can download on the iPhone. You can track the miles. There's one way to do it. And the IRS rule is you don't need to track all the whole year. You can track 3 months and you extrapolate. You can times 4 to get a whole years. That is one acceptable approach. For me, I just do the whole year because it's for just to quickly scan the track the record, how many miles to business meetings, how many to the rentals, I can split. And the record keeping, all the receipt, meals, right, the repairs and the supplies, copies, postage, everything. Try to keep the receipt. I use Need Receipt. Some people use Shoebox, some people use QuickBook. Just find the app, use that, okay? I wanted you to do it because in case you are audited by IRS, and they are going to look at your receipt. So I cannot produce because it's your job. So please have your receipt ready, put it into digitize, put it in the cloud, and keep it for 3 years. After 3 years, you can disregard because you don't want to. The statutory requirements are 3 years. After that, you don't worry about that. Okay? And I keep getting K1 limited partner returns. K1, here's the problem: is many K1s coming very late. I've seen situations I already filed a return. Suddenly, the client said, "Oh, I got a K1 from Schwab." It's very interesting. The Schwab, some brokerage companies, you buy their stocks. Sometimes they also have a public traded partnership. You don't even know they purchased them, and the K1 came in. The rule is if your interest income from the K1 over $10, you have to file a minimum return. That's very painful. Can you imagine? You already filed the return, you paid the accounting fee. Because of $10, you have to ask your accountant to the minimum return, costs you $200 because you have to mint. Totally waste of money. Okay. So please, if you have this situation, I would rather you just file extension, just wait, gather all the K1s, then you file. It's not fun to submit it and return and get amendment, and it's just not fun. Also open the book twice to IRS. Really you get unwanted attention from the government. Why do that, right? So K1 is painful. Some people use K1 to buy rental properties. I don't like that, but I'll let you why. All right, sell rentals. I've seen people do sell rentals. Here's the cases. If you sell rentals, make sure you do a little bit. I call here's the technique, right? When you sell properties, you track all the rental. You don't sell houses often, so prefer you have a professional do for you. For instance, how to track the base, how to calculate the accumulated depreciations, right? How to count all this selling expenses, the fees, the charges, attorney fee, brokerage fee. So it's good. I want you to do that. When you have a kind of rental property sold, you have long-term capital gain. I prefer you sell some stocks. I've recently have a consultation. The person sold a rental, get a $1 million sales, profit, and because she forgot to sell some stocks to realize some gain to losses to offset, and turned out she paid more taxes. And this year, when stock market going down 15%, she kind of regretted because market coming down, right? I would rather, when you sell the house, get a lot of gain from rental, try to liquidate some other properties, try to produce some losses, try to offset. So this kind of planning is important. You don't want to consult with the accountant in April. It's too late. Something should happen before even the year end. So that's why sell rental, you always want to pair it with some other losses, called loss harvesting. This is number 3. Number 4 is stock over concentration. I've seen people's brokerage account have a lot of technology stocks, right? The Significant 7, Magnificent 7, have a lot of the single names. It's not good because we all understand you cannot beat the market forever by doing trading in 1 or 2 single name stocks because too much concentration. So I prefer, please mute. I prefer people to, when you have this kind of over concentration of certain things, you try to gradually balance out. How to do that? You sell some stocks in a capital gain, and you sell some stocks at a capital loss. In that case, you cash out, then you offset the gain or loss, you pay very little tax. Then when you have the cash, you turn into S&P 500 or Warren Buffett, Berkshire Hathaway. In that case, you gradually unwind your stock concentration. You purchase broad-based, low fee, and also Warren stock is always long-term view. So I prefer you gradually retire your technology stocks, put into other ones. So in the broader market. And do not do it in the wholesale fashion. Do not sell 1,000 Apple. You cause so many capital gains. I will repair. Pick some good ones, pick some lousy ones. You sell at the same time. You offset each other. So okay, take a little bit homework, but it's worth it. Okay, and RSU is a big deal, right? I have few clients from Apple, from NVIDIA. They have a lot of RSUs, restricted stock units. You already paid 22% withholding from your W-2. If you sell stocks, you have to pay another 20%, maybe 23% capital gain. And that's federal level, and the 5 or 10% state level. It's not efficient, too much. So when you have RSU, you have two ways. Either you gift away to your children. When they have a lower tax bracket, they can sell that, use your base, they pay lower tax because, the younger, college kids have a lower bracket. So gift away. Then you cash out, right? In that case, that's one way. Every year you can give away up to 19,000, 20,000, not bad. Your wife can do the same thing. And or you can set up a family foundation to donate your stocks, RSUs, into family foundation. In that case, you can sell stocks in the foundation, you pay zero tax, almost zero, 1%. So that's why when you have RSUs, you try to unwind this bond in an efficient way. You already pay 22%. Do not sell anymore. Give it away and donate it away and unwind this, okay? People said, oh, I pay so much tax. Can I donate it by April 15th? Sorry. Any donations has to happen before year end. That's why year-end consultation is so important. So many things you can do that in the last 2 weeks. People need to learn lessons. Roth conversion, yes. Backdoor Roth need to convert, finish by 12/31, same concept. Okay. I think HSA can contribute before April 15th. I think not extension. AHA's health savings account contribution cannot over. So be careful. Rental cost segregations can be done by tax filing date. I think that's a good strategy. Fred, are you here, Fred? Can you share a few examples how we do cost segregations even after the year end?
Yes, I'm here, and as long as you do it by April 15th, you go to a company, depending on how big your property is, and they either have to do an on-site or that we can also do over the computer an engineering summary, and you can accelerate your depreciation a lot more in the first 5 years. Save quite a bit of money in the time value.
Yeah, cost side is good for real estate professionals, good for short-term rentals, not for long-term rental where you have high income, you don't qualify REP. So not every situation, but my point is if you have 5-6 rentals, you think you qualified, and you should give it a try, because I've advised several clients to cost segregations. It works, right? It works. All right, number nine is a big deal. Supplemental information TurboTax. I found so many people use a TurboTax or other software. They could not upload the PDF, the documents. For instance, you have a special situation, you have to tell IRS what happened. That's one powerful form called 8275. I don't even know how many people know this form. I found it's just 80 what? Hold on a second. 8275. All right. So this form is called a disclosure statement. This is specifically for people who do not use professional software, meaning you don't have PDF upload function. You can use this form to tell IRS specific situation. For instance, you have rentals, right? Let's say you have rental and depreciation line, I forgot, let's say 25, I forgot depreciation line. Amount is, let's say 5,000. You said taxpayer did not take straight line depreciation, right? Sorry, my typing, depreciation for the past 4 years. So 2022 to 2024, right? This is one-time catch-up. So you tell IRS you have a specific line item for additional depreciation, and why is that about? You tell IRS that it's come from this. I forgot the straight line depreciation. I need to catch up one time. Instead of file the 3115, you ask the accounting CPA to charge you $500 to pick one form. You can do that. So this form is very important. When you have a supplemental information you don't know where to do, apply this one. This is good, okay? And so this is one way to do that. And also you can do multiple forms, one for Schedule C, the other for Schedule E. You can do, depends on the situation. I think this is one good way to tell IRS. And when you do that, I hope it works. Because when you file that, IRS will see that, okay, you have this special situation, you disclose that, and you tell IRS it's good. Right, disclosure, yeah, you tell, like that. It's beautiful. So please, this is a very powerful tool, and I didn't realize this until recently I read something. Wow, yeah, this is a very good point. So that's why I can't wait to share with you, okay, this form. All right, so that is, then the last one is kind of a selfish situation. When it's a good idea to hire a accountant to do for you? Cost aggregations, real estate professionals, short-term rentals, your large LLC with the payrolls. You have you sell the house, and all these situations are too material. You don't deal with often. I prefer you hire somebody to at least you have a consult. You don't want to save a few $100 just do by yourself erroneously and mistakenly. You need to hire a professional to do it for you, for the kind of special one-off. I call it special situation. All right. Okay. With that, I'm going to go into some case studies. All right. Let me ask people to. Let me pick a few people. I know so many iPhones. What the heck? All right. I'm going to ask Jesse Shales. Can you do the first two questions? After that, it will be Carrie. Okay, Jesse.
Sure. Yeah. You want me to read it, right?
You read the first one, then we talk, then we read the second one. Yeah.
Okay. 1. Husband and wife established a 2-member LLC running a yoga studio. They consulted a CPA who charged them $1,200 to file a 1065 partnership return with K1. What can they do to avoid such expenses?
Everybody know you have a single member LLC or multi-member LLC, right? Single member LLC go to Schedule C, disregard entity, very simple. But when you file application with a 2-member or multi-member LLC, you suddenly create an entity. It's called a partnership. Even husband and wife, IRS doesn't care. 2 people. You are required to file tax return as a partnership return. And you know that partnership business return you cannot do yourself. And on average, national average, $1,200. That's the average. So, Jesse, how do you think you can get around this thing?
No idea.
So, this is the situation I have. There's one couple like this. They called me. They said, it's already April 14th. I have no way to hire somebody to do tax return for me. I wait. They are totally just, paranoid. I said, don't worry. File QJV, Qualified Joint Venture. Okay, Qualified joint venture is a special situation for husband and wife owned multi-member LLC. Instead of file partnership, you can file your own Schedule C or rental properties. I call it, if you go to Schedule C, right? What they do is you tell the, sorry, my computer is freezing on me. You tell us we have a multi-member LLC, husband claimed 50% of the revenue and expenses, and wife claimed the rest 50%. So that's why you can use this way to split. Okay, sorry, the US student, for instance. And when you do this, you have two Schedule C's coming. Half go to husband, half go to wife. Use the same EIN number because you only have one EIN, right? The tax code. And then you file this 8275, remember that, right? You do that. You set a qualified joint venture, Schedule C, whatever amount it is, right? You explain that because it's husband and wife, and LLC file the QJV selection election. You do that way. That's in that case IRS. Oh, I understand. So you don't need to file 1065. You don't need to pay $1,200. You can do Schedule C half and half. Very smart, right? Like this idea. So that's one way you can get around this. Again, when you have people want to file multi-member LLCs, we always think twice because multi-member LLC is not cheap. Unless you have a very viable business, otherwise sometimes it's not worth it. Okay, not worth it. All right, Jesse, number 2.
Number 2, parents have high deductible health insurance plan with adult child, 18 to 26 years old, as healthcare insurance dependent. Should the adult child set up his or her own HSA? What if the child has no income in 2024?
Yeah, what do you think? Everybody know HSA, right? Very powerful tool. Anybody have any thoughts on the HSA? We all understand the tax loophole is if family have a high deductible, if your child is 18 to 26, it is a good idea to file your tax return to set up a HSA for your own child. Okay, that's the strategy.
Can we still claim the child as our dependent if we set their own HSA?
Nope. Yeah, the rule is if your child has his own HSA, he need to file his own tax return. You are losing 500 deductions, but I think it's worth it. Let me share you what I'm talking about. Okay, I did my son's tax return. For instance, this single red flag 19-year-old, and look at this 8889. 8889 is the health insurance savings account because the plan is high deductible family. My son Fred, can also enjoy the same $8,300 family deductions. That's very powerful. And assuming he's in college, he gets some money, he gets some, he work with Starbucks, he gets some income, W-2 income. In that situation, he get a $1,500 income. So if you run his tax reform, let's see how that goes. First of all, if you look at his Schedule C, HSA deduction $8,300. So meaning what? Your child will have Schedule 1 reduction of income $8,300. Very powerful. Number 2, if you look at the health savings account money, if you read the line number 2, HSA contribution you made, meaning Chris, my son, Frederick, or those made on your behalf. Do you see the second in the parentheses? This sentence is so important, meaning what? For your son, for your child, they can set up HSA does not have to be earned income. Can be the parents gift money to made on their behalf. So guys, this is the best of the whole world. You gift $8,300 to set up HSA, and your child use $8,300 to deduct his little, W-2 from internship with Facebook, and he pay no tax, zero tax income. So that's the beauty. Yes, you lose 500 deduction as a parent, but your child get the whole world. So when the child have a little internship, he or she can set up Roth IRA, $7,000, buy Warren Buffett stock, and HSA $8,000. Gift. You can gift the money and they save tax. Best. You don't save tax, they save tax. Why now you can give them some stocks? They can sell stocks, they get capital gain, pay very little tax, 10% tax. So you gain 3 times. So you leverage your child low tax bracket, you gift them money and reduce their tax, and you give them stocks so they can cash out for you. Instead of you paid, 23%, the long-term capital gain tax for your NVIDIA stock. You give away and they sell that.
On that, Mike, I have a question. For example, if I have an NVIDIA stock, say 1,000 shares, I want to cash out, and I will be hit with a huge capital gain. Can I gift all of that to the kid and they sell it? But I think, will there be a cap?
Yeah, you can give some stocks, but the problem is if you give more than 20,000, you have to hit the 709 gift tax return, right? Gift tax return you cannot do yourself. You can hire somebody, charge you $800. Same thing, your child can only sell the stocks up to $45,000 to capital gain. Other than
45,000?
45, because the long-term capital gain zero tax bracket, it phase out its income is 45,000. When your capital gain 45,000 more, they start paying taxes. So you have to phase out gradually, not a one-time deal. You cannot give a lot. Just give piece by piece. Yeah. All right, go back to. All right, Carrie, can you do 3 or 4? After that, it will be Ted.
Sorry about that. Hi, American Opportunity Tax Credit has $1,000 deductible refundable credit, but has an age condition of 24 plus. Can my child between 18 to 22 still apply for this?
What do you think?
No.
I know, right? The rule said. Good. This is sort of a tax code gray area, and I know. I kind of tell people sometimes tax law have very clear conditions for AOTC, the refundable credit you have the 80/24, but there are some tax softwares ignore this age rule. For instance, for my tax software Drake, they ignore. They know my son at 18, 19. I tell them, they are in college, never do AOTC, applying for that in Harvard, spend $4,000 this one. I run it, and if you run tax return, do you see that? My son get line number 29, American Opportunity Tax Credit, 1,000 cashback. They get a return. So that's why the first person, Jesse, you mentioned that, or whoever you said that. Yes, you lose $500 dependent credit, but the AOTC itself give you 1,000. You double the benefits. So far, I've been doing that for 2 years for my son. Never get audited. Do you know the reason why IRS give you this? They know your child's 19. They know you break the rule, but they didn't even bother you. Why is that, Jesse? I think there are some moral considerations in the tax system. The government does not want to offend young people. For instance, they clearly said if you withdraw money from 529, you have to buy for college-related expenses, right? But what if you draw the money from the 529, you pay for child other expenses? For instance, his car loan or his his living travel expenses. I never heard of any IRS tax law audit on the 529. Same reason. So let me ask people, Carrie, why IRS does not audit young people? Why is that?
Because they don't have a lot of money. So, and
Yeah.
you don't want to tax them.
Yeah,
You-
you found errors. He's only 19. You really get nothing, and you create a lifetime enemy. Right? Can you imagine Chris was audited at age 19? He will hate IRS for his whole life. So he will never pay any single dime. He always very cautious, find the best way to save tax, and IRS just to create a lifetime enemy. Why he does that? IRS doesn't think that's a good idea. He would rather tax high income people like Carrie, give the young people a break. So rule is a rule, but when they implement the rule, when they execute the rule, there are so many vague areas. I understand the rule, clearly say you cannot do this, but even software, I heard there are 2 softwares bypass this. Even you are under age 24, you can still get an AOTC. Not bad, $1,000 a year, 4 years. So your child get $4,000 back. Not bad at all. So people, when your child's 18, let them go. Let them get $1,000 tax credit and set up HSA for them and do them do the what they call the Roth IRA for them, right? That's good stuff. And do not bring any wing anymore because they bring more cash, more value than your $500. Please just think out of the box. Just think against the traditional way. All right. We talked about the number 4 we did already, so you would rather file tax.
Okay. So Mike, should I go with number 5?
Please.
I claim my child as dependent on my 1040 return. My child gets W-2 with income tax withholding. How can I have my
Yeah, how can you get money back? Here's a situation. It happens all the time. For instance, you claim your child, he's 18, he's 17, right? He doesn't go to college. So you claim him as her as a dependent. But sometimes these young people work at the coffee shop, work at the Target, they get W-2, they get withholdings. Withholdings, number one is when the young people file the form for the W-4 in the any Starbucks or Chick-fil-A, many times we just fill the W-4 wrong. We shouldn't ask government to withhold income tax because their income is so low. They're below $14,000 standard deduction. Their income will not work in Starbucks. I don't think they'll get 14 or more. So do not even withhold. Please claim more. I know Ted is going to share with that. So have more deductions on your W-4. You have a 0 deduction for your real withholding for your W-2. In that case, you bypass this issue. So that's why the payroll setup is so important. I've seen young people, withhold 10-20% of tax from the little income. Why is that? It's waste of money. You give the interest-free loan to government for 16 months. Why do that, right? So definitely do not always have a W-4 fill out. Think of that. Ask GPT to help you to optimize have zero income withholding. I think that's the best strategy. Unfortunately, in that situation, I've told client, yes, you still file your child as your tax dependent. You get whatever, $500. In the meantime, you need to file a little return for your child. The little return is, you can get some money back, at least to get this W-2 money back. I prefer you use Free Tax USA, or Free Tax. Arthur, are you here today, Arthur? I don't know where Arthur here. Yeah, use this software, okay? So Free Tax USA, it's free, and for state it charges you $20. I think it's worth it. So get the money back. But here's the trick. The trick is IRS are worried about the identity theft. When you use your child's social security number in your dependent, so the IRS system already find your child's social used once. So when you file his or her own return, you submit it, it get rejected. IRS said your social security has been used once by some other people, maybe your parent, and you cannot use anymore. So here's the trick. Most cases, people have to print out, file paper return to IRS because they have to explain, my son was used by dependent, but he had reduction. This year, they have a new rule. I call it the convenience rule, expedient convenient. What it said is you can apply for IP PIN. So your child or you can do that. Apply for the internet protection PIN number for your child, and when you file return, you put IP PIN in the return. Let me show you what I'm talking about. E-file. Do you see that? This is the IP PIN, right? So meaning what? IRS, when you have the IP PIN applied, you put it here, you can e-file. IRS understand, yes, this is still you because only you know your IP, and you can file twice. One for your parent dependent, the other one for yourself to get the money back. So this is one I call the trick. So lesson learned is have a better structured W-4. Do not withhold. He's so young. She's so young. When you have that, get tax returns to IP PIN. Okay. So that's one way to get around. All right. I'll ask Ted to do it. After that, it will be, I saw Laura. Laura, okay, it will be next one. Okay. Ted, can you do number 6, 7? Oops, sorry, this is my mistake.
Okay. I did front door Roth IRA. At the end, I found out my AGI exceeds the threshold. Can I unwind my Roth IRA contribution? I'm gonna say no to that.
Yeah, I know all the good stuff have limitations, right? IRA, when you have joint income, I believe it's $220,000. Some situation you don't. When you have W-2, you know your income. Let's say my income $212,000. I can do Roth IRA, no problem. Unfortunately, if you sell some stocks last year, you get a lot of capital gains, and that also added into AGI. Suddenly, you're over 220. In that case, you have to call the Schwab Vanguard to unwind. The answer is yes. You can unwind the Roth IRA, you get the money back. But in this year, when the stock market, 2024, is up, so you are going to pay income tax on the capital gains. So in that case, what you do is here's the situation is that in the Schedule 1 4A 4B, see, I won $65,000 because I'm not qualified. Because during that situation, my stock, like Roth IRA, gained 10%, $600 taxable income. So that is your treatment. You call Schwab, you get the money back, and you have to report the income $600. In that case, when you run the tax form, This happens all the time. People over contribute. Sometimes you have good intention, but have this that. You tell us, I get the money back, and only 10% are $600 are taxable income because the interest earnings or dividend earnings. So that's how you do that. So you still pay some taxes, but do not ignore this, because if you over contribute, you might hit it by the 6% excess tax. They charge you every year. It's not efficient, so don't do that. So I would rather unwind. All right, so that's good. How about the number 7?
I decide to file an extension. How to pay the IRS online.
How to pay?
Isn't it when you file the extension that there's a box that says, how much are you contributing
Good
with
point.
the extension?
Yes, when you get extension, you know how much money you owe. At least you are still, let's say you're waiting for a few K1s, it's coming late. You know the ballpark. I prefer you go to IRS direct pay, right? And you can pay your income tax through the bank statement. Do not use credit card. The credit card charges 3%. So just do using the bank statement, pay a bank routing checking number to pay. So that's what I call direct pay, right? That's one way to deal with that. Same thing for each state. You can e-pay to your state level as well. So I think that's one way I found is you do that before April 15, because IRS said even you extend doesn't mean you cannot extend you cannot delay the tax dues. If you owe IRS, you have to pay by April 15th. When you do that, you just use the direct pay function. Yep. All right, thank you, Ted. Now go to Laura. Laura, after that it will be I saw Logan. Okay, Laura, can you do number 8? 9?
Number 8. I want to provide additional explanation to certain elections in my 1040. What form should I use in 1040? Oh, the one you just explained, the supplemental is 8275, right?
35, yes. Thank you, Laura. So there are 3-4 different commonly used elections, or you have to tell IRS. One is the $5,000 business setup cost, right? When you have first year LLC, you can have startup cost $5,000 safe harbor, another $5,000 for the organizational cost safe harbor. It's free money, give you deduction right out of the spot. So if you don't have this kind of function, because it's a professional level software, they give you all the different election boxes. If you don't have it, you use this 8275. You tell us Schedule C, I disclaimed safe harbor. I think for safe harbor, the code is I forgot what's the $5,000 startup cost safe harbor tax code. I think it's section 183. I might be wrong. Or 195. You said? Yeah. So what you do is you tell IRS when you do this 8275 and 8275. So this is spouse. So this is, you tell this one. So LLC startup cost safe harbor. Schedule C, line 35, cost is $48.99, something like that. Okay, and explain. This taxpayers elects startup. Right, you do that. So tell IRS, do not audit me. This expenses are legit. This cost I set up, I consult with accountant, I do my So this is one way you do that. Okay. This form is important. Okay, Laura, number 9.
I borrowed a loan from my cash value life insurance policy to use as a rental property down payment. Can I deduct interest on my Schedule E?
What do you think?
Use a rental property down payment. Can I deduct loan interest? I think so.
Yeah.
It,
When I
I think it's like two different things. You borrow
it's
a loan from cash value, you
Mhm.
pay the loan there, but rental is rental and cash value is cash value, the loan.
That's a good part for IRS. IRS is called a tracing rule. Tracing rule is what the government doesn't care where the money come from. You borrow from home equity, from somebody, from a family member, doesn't matter. As long as you use this loan to put into business, rental is a business, is income producing. So that is a business loan. The business loan interest is deductible. Okay. So that's a very good strategy. What you do is in the Schedule E, let's say this person, okay, you use this line 13, this is interest others. Because down payment, right? You have down payment, you still have mortgage. Mortgage go to 1098. That is the right, the mortgage interest. But for the interest down payment others, you put this one. You do what? It's a loan interest from cash life insurance. Most cases is 5%. If your down payment is $20,000, 5% is $1,000.
So the loan interest is the one you paid to the life insurance loan, right? The down pay interest.
Yes. That's why you gather the rental income from a tenant, and let's say you receive 40,000 from a tenant, you write a check to use the one check to write to insurance company, pay the interest $1,000.
Yeah.
So that case, that's why I highly recommend people to buy life insurance. Same thing before you can use that as your ATM machine. You borrow that anytime if you need that, and you can use this deduction. You save money, meaning you are not paying 5% to life insurance company. You only pay 3% because you save 40% taxes here, the state and the federal. This is number one. Number two is this kind of loans are so flexible. IRS, the life insurance company never check your W-2 or FICO score or mortgage. Doesn't matter. They don't even audit you, look at your credit. Doesn't matter. They just give you a loan immediately. So this kind of loan is much better than bank loans. Bank checking so many things. They worry about that. They worry about this. It takes so long to get a loan, and sometimes you don't get a good rate. Who can get a mortgage rate of 5%, right? Mortgage rate of at least 6%. But life insurance get a lower rate, still can deduct, win-win. Okay? And also you get a cash flow compound. So please buy some cash flow life insurance, good stuff. right.
What if, Mike, what if I don't use it for business purposes?
Now you have to, otherwise, let's say you borrow a loan, go to vacation, that's you can't. But if you borrow a loan to pay your medical expenses, it may be deductible and on Schedule A. Or you borrow a loan, but if you borrow a loan to pay your child college, no deductible because college is not income producing. Tuition is wasted, yeah. So it's not going to give too much value. I prefer you do that, in the right way.
Yeah, because this one is like a rental, you can deduct expense.
Yeah.
So
Whatever you borrow a loan, buy a car. If your car is used for business expenses, you run a short-term rental, long-term rental, consulting, like me. In that case, I can deduct my life insurance loan. Same thing, because sometimes depends on your arbitrage. Car loan is, if your car loan too expensive. Recently, my son bought a car. We co-signed for him 7%, and because my DTI, debt to income ratio, too high. 7% is not efficient. Why not I borrow a loan from life insurance? And if my son used that for his business, he can deduct. Still good. All right, that's good. Let's move on to another person. I said forgot who do I mention? I mentioned somebody. I forgot. Logan, right? Logan. After that, Michelle. Logan. Number 10. Logan down here. Michelle, can you do number 10? All right. I don't know. Who else volunteer? Anybody volunteer?
I can do number 10.
Okay.
I moved in 2024. I remember that moving expenses are generally not deductible. What if I have a business home office?
Think of that. It's recently happened. The one CAPA member is moving. She's moving to West Coast. I said, why not you deduct some expenses if you have a business? If she has a business, it's profitable, and you can treat it as, for instance, you are, let's say you are, I don't know, a consultant in business. You have a lot of files, client information. You have to put in the box. You have to put into the U-Haul. You drive West Coast, and this kind of U-Haul expenses, if you can prove IRS is my home office expenses roughly is 15-20% of my whole house, then 15-20% of your moving costs could be deductible. Put into Schedule C. Put in the other expenses, business moving, right? You are not moving a house, you're moving your business entity. When you move, the moving cost deduction. I understand most cases moving costs are not deductible, I understand. But if you think of out that way, if you think of the business expenses, you have to move the business, you have to protect the client files, all this, PI information. Then you do that, they are legit business, you can deduct. But not too crazy, right? 15-20% might be okay, but not more than that. But for Ted, he has a home business. If you move all the equipment, right? You have all this machinery, equipment, inventory, you move business deduction, right, Ted? I know you don't want to move, I just tell you.
I don't want to move for sure.
All right, let's move on to go to who else do this. Fred, can you do number 11, 12?
Sure. Number 11, I overfunded my HSA and how to unwind the excess. What about earnings on the excess?
Ah, that's what I get tricked myself. Do you know why? I told people HSA is $8,300, but I forgot that my company matched $2,000 in it. So when I fully funded at a year and I found out, oops, I found 8,000, my company matched 2,000. Suddenly I overfunded. You have a penalty. So I have to call the HSE, an administrator said, can you unwind $2,000 because I overfunded? Yes, I can do it. This is your contribution is tax free because you just withdraw money. But the income earnings from this $2,000 from the stock market have to pay tax. So where you pay? So that happened to myself. Oops, people knew. Yes, the people is here. Is line 8Z. Okay, let's say you have $500. This is your line. Okay, you tell us I unwind my HSE over contribution. I have a taxable income, interest earnings $500. You put it into 8Z. I know 8Z is the code of a kitchen sink. Anything you cannot explain, you put 8Z. Okay, that's the interesting field. Who knows the stuff? Yeah, my personal lesson. I overpaid. I have to pay tax on that. Right.
Is there a penalty on the excess interest that you make?
No, no penalty. You just get out before tax filing, so you can pay. You just pay tax on earnings, no penalty. But if you do not unwind, you over contribute, your penalty 6%. 6% of the over contribution per year. So it's add up. I recently have a consult. This lady from IRS. She worked with IRS. She overcounted SSA. She get hit by $2,000 tax penalty. Can you imagine? Even IRS people couldn't make a mistake. Couldn't make a mistake like this. It's funny. All right, number 12, Fred.
Charity contribution $2,500, but unused in my 1040 due to itemized deduction below standard deduction. What should I do in 2025 and going forward?
Yeah, I get a hit all the time. People donate to church or this, but if you don't have good standard deduction, this money is really wasted, right? You don't have much. Because do you follow my point? Yeah. So because your standard deduction is $14,000, a lot more than $2,500. So Ted, Fred, what do you think?
Yeah, a family foundation, I guess would be the only way to get around that.
Yeah, you can donate a big money. You can do 25,000 to a foundation. Then from there, you make donations. You get savings here. You have a cookie jar in the future. You just release your foundation money, piece by piece. That's one way. Let's say Ted has LLC. Can Ted use his LLC to deduct as a business expense? What do you think, Ted?
Yeah, I think I can do that. But yeah.
Let's say you use a business checking account to go to church. You write a check, use your SOAP LLC. IRS said, nope, you can't do that. IRS said, this is your disregard entity. The Schedule C is single member LLC, pass through to your account. So they treat it as your direct deduction from your Schedule A. So you cannot do it. So the only way Ted can do that is have S Corp. So if he has S Corp to donate, that's a business entity. So he will create a business deductions on S Corp, reduce his Q1. That's one way to do it. So meaning when you have this low, not impactful donations, either donate a large amount to family foundation, do it that way, or have your own S Corp do that. But again, that's whole different set of stories because you have to pay different payroll stuff. All right, so that is charitable. Number 13, 14. Let me ask who are people? Xiaoling, can you do number 13, 14, Xiaoling?
Okay, number 13, I had a large gain in 2024 by selling stock or rental. I've got to pay income tax withholding.
Yeah, when you sell the stocks in the middle of the year or rentals, do not forget about that, right? So that's why when you have the large business transaction, you need to consult with accountant at least to know how much money you owe. Then what's your action plan? I want you to do not to do the get the money into a check account. You're happy about that. You have to think, what do you mean for tax, right? Have a consult. You already get a 500K capital gain. Doesn't hurt to have a little consult with people. And most tax accountant will tell you this is your how much tax implication for the sale, and you have to pay tax in advance. So here is a screen. What you do is you go to IRS direct pay, but you have to do a record keeping. Do you see this is the estimate tax? For instance, you sold a house, and you tell the government, I sold my stocks, I sold my house, I owe you $2,800, $20,000 tax. You put in the date. This is 4 key days you have to remember: April, June, September, January. So that's the key days you pay tax for that quarter. Okay. So when you sell the house in certain quarter, that 15th of next month, you need to pay tax. If you delay that, and you might get hit by 7% penalty because that's government rate, 7%. Not only federal level, you need to pay state level, same thing. Okay. So pay as you go, that's the rule. All right, so that is Xiaoling's number 13. Xiaoling, can you do number 14?
Yes, sure. Number 14, I early joined my 401k to pay for child college tuition. How to avoid the 10% early withdrawal penalty?
Yeah, people sometimes you have something going on, you have to pay early withdrawal. Yes, IRS have 20 different situations. You can early withdraw without 10% penalty, but you need to file 5329. How many people know this form, right? 5329. For instance, your child is 18, you are withdraw this money. This is IRA money you can withdraw, pay for higher education expenses. Again, same situation. IRS will not audit you. They know you have a child go to Harvard. They know you're going to pay a lot of money. So they're not going to audit you. So don't worry about that. So I want you withdraw from this. Tell the IRS, do not hit me 10%. I'm 53, not 59.5. But to this form, select code 08. Okay. Let's look at the codes. The first code is a separation from service. That applies to the Doge people. So when you are doged out by the government, so your TSP, you can file this one. If you are over 55, government said, yes, you are not 59 yet, but you're laid out by government, by Trump, you can take money out without 10% penalty. Select code 01. Again, you still need to pay the income tax on the traditional 401k draw, but the 10% is waived. The second one is the substantial equal period. Fred, let me ask you, what's the difference between 1 and 2 code?
For the, you have to, there's 3 different ways to calculate how to get to 59.5 with the number 2 code, the SEPP, where if you're separated from service, that's kind of a one-time thing.
Yeah, for the SEPP substantial, you have to equally draw every year until 59. So the code number 1, number 2 difference is, the first one is if you are age 55 above, you only have 4 years to do, right? You just can do whatever you can. You can do withdraw $10,000 this year, next thousand you can jump to 20,000, doesn't matter. But the first one is the best for 55 plus. The second code is for any age. Let's say if you are doged out by age 49, you still have 10 years. Between 10 years, you can use second code. Substantial equality payment, in that case, equal payment, you get a little, not too much because you have to stretch out by so many years with RMD table, but you waive 10%. So the second one is give you equal payment from whatever you are that age up to 59. It's much longer, much smaller, but the first one is more flexible because you are 55 above. Okay. And permanent, yeah. So number 9 for medical expenses, you can do that. And number 8 is college. And number 7 is unemployment individual for health insurance. So when you have health insurance, we all laid off, you can take money out, but that's still good. We waive the 10%. When you withdraw money from your Roth IRA, Roth TSP, even better because you don't even pay the 10% and not pay taxes, it's totally tax free. That's why, yes, we understand 59.5 is like a jail time, but you still have at least 20 different ways to get out. Okay, that's the code, number 8. All right, last one is I did the backdoor Roth. Everybody understand backdoor, but this especially this year, when Trump did the Liberation Day war, the terror wars, the stock market is so volatile. It's a good time to do backdoor Roth now, because it's the peak time is 6,200. Now is the 55. So you get a good time to do it. When the market rebounded back, everything normalized, you get tax free. So you can do backdoor Roth now, before you do not be too late, right? I think the.
You mean the backdoor Roth transfer the stock?
8806，我写，hold on a second, what's the? I forgot my HSC 8606 ，OK， 4K。People mute. All right, for this backdoor Roth, you use the 8606. Tell government I have, non-deductible, meaning no tax implications. Just tell IRS I have a backdoor Roth. That's about it. Okay, you don't pay tax, you don't save tax, just because you're too high income. You can do that. For young people, for low income people, you don't worry about that. You can do front door Roth. Okay, this is only for backdoor Roth people. It's for high income people. Yeah. Okay, I think
So,
we've.
Mike, on that, if I want to roll over my former 401k, my former employer's 401k plan into the IRA, which the IRA I used for backdoor Roth conversion. Does that mean I have to stop doing the backdoor conversion?
Yes, that's a problem because the pro rata rule kicking in. That's why when you things get more complicated, I prefer people do this is when you roll over your old jobs 401k into IRA is traditional to traditional. You cannot do back to Roth because of pro rata. And I would rather you use some other strategies. For instance, just do Roth conversions. Just clean up, IRA traditional. That's one way. Just do Roth conversion. Do not do Roth back to Roth. Just wait. And you and your husband. One way to do that. Sorry, just for you. Your husband can do back to Roth because your husband has different account, so he can do that. The other way is you set up a small business, right? For instance, I have a tax consulting. I have a solo 401k with E-Trade. I get approval from E-Trade yesterday. What I do is I move my company's 401k to E-Trade solo K. So I don't even touch my IRA. So my IRA is still zero. So I can do back to Roth. So I just clean the space for IRA to do back to Roth. My 401k money, I move to my solo K, no fees. I can buy Warren Buffett stock. That's another strategy. Okay. I prefer this way, meaning set up a solo K. Why E-Trade? Anybody know why I pick E-Trade? Anybody know?
Can you take a loan against it with E-Trade?
Exactly. Smart. Only E-Trade 401k can take a loan out of it. $50,000 loan. Vanguard doesn't have it. Fidelity doesn't have it. Schwab doesn't have it. Only E-Trade. That's why I highly recommend people, if you want to do solo K, do E-Trade. I did that. I filled out it approved. Kind of painful. You have to paper in, but you are able to get a loan. Not bad, right? You can get a $50,000 liquidity. And your current job, you have this. Your prior job, you have two loans. You can get a $100,000 loan. You can buy a rental, nice rental, down payment, and you have cash value life insurance, get a loan. So you have so many liquidities. Can you imagine you have a husband wife times 2? You can have like 4 different loans. Liquidity. All right. Take a look at questions. Start from beginning. Okay. I'm a K1 guilty, Fred. Okay, K1 is partnership, limited partnership. Okay. How do you feel about the Berkshire now, Warren? But yeah, we talk about that. Yeah, don't worry about that. Because Warren's Class A stock has been $800,000. When there's super rich people still loyally follow him, our $40,000, don't worry. Okay, rich people, don't worry. Why us? 不用操着心哈. Right now, I have HSA account. It seems like I shouldn't do FSA because yeah, absolutely. Each person can contribute how much for each account. I don't know. I understand this. HSA is per family, right? 8,500. Adult, same thing. Yep, people already answered for me. Thank you. I heard someone self-directed IRA can buy real home to flip house. Yeah, you can buy self-directed IRA to buy houses. It's good and bad. The good thing is, you give you another way of investors. The bad thing is, all the self-directed fees charged on that, and also this is in the IRA, tax deferred. So all your cost aggregations, bonus depreciations doesn't work because you don't save tax on that. You create losses, doesn't give you anything. So just like you have 2 tax preferred arrangement bundled into one, you lose the benefits. So I would rather you use Roth IRA to buy Warren Buffett stock or like that, and your HS life insurance company borrow loan by rentals. That's much better. Okay, yearly 80, I think now it's $8,500 like that. If you're over 55, you can add another 1,000. Contribute the tax double earning. Yeah, exactly. Yeah. Okay. How much can you move previous from? And no limitation. You just parallel. Yeah. I prefer you do not use. Here's the deal, guys. you definitely need to set up solo K. So you have a small business, even if you have no income, you can just have a blank and you can roll over. At least you have some funding to move from one spot to another. You can get out of this company's high fee, low performance 401k. That's totally get it. You can move all together into E-Trade is fine. But the point is, you still want to do Roth conversions, but I don't know E-Trade. Maybe E-Trade can do Roth conversion. I don't know. You might do that. But IRA Roth conversion more flexible. You might ask that. Let me ask ChatGPT of this question. E-Trade solo K, can they do in-program Roth conversion? I don't know. E-Trade. Can I do Roth conversion? All right, some like okay, but only also. Yeah, submitting you can do the Roth conversion. That sounds like you can roll over a lot. That's fine. Yeah. All right, so I only have Roth IRA 401k to roll over only once. Roll over IRA to roll over multiple times. Would it go to Pareto rule? Yeah, the Pareto the way, Michelle, to get around the Pareto rule is you move most money into your solo case. In that case, you clean up your IRA account. Can I consider HA solo K the same year? Yeah, why not? But based on income, your solo K, you need to have income, right? So you have, for small business, if you have income, then you can do that. So your net income plus 20% of the matching, you can do it. If you, most cases for my situation, if you apply 5,000 startup costs, 5,000 organizational costs, you lose money. When you have a negative Schedule C, you cannot contribute because there's no profit. So that's the only way it limits you. Roth IRA, be careful, your joint AGI. Husband AGI too high, you can only do backdoor Roth, be careful. For bookkeeping about rental property, how to handle remodel, repairs, gardening, most time they want the cash. Yeah, I think I prefer use Venmo or PayPal because that create a 1099K. So you are the hook of the 1099 NEC. So do not do cash because cash is not auditable. And I know people want the cash, they don't want to pay tax, but your job is protect yourself, right? I prefer you pay Venmo or PayPal, not a Zelle, okay? I've changed IRA before. I made a non-deductible contribution this year. How should I do backdoor out now? That's you can still do backdoor Roth. I think the best way just the backdoor Roth. The best website is called a White Collar. This website gives you the detailed step-by-step instructions. I think that's the best. Okay. Yeah, the Zelle does not produce 1099K. That's a problem. Yeah. That's why Zelle is not good for you. Okay. Okay, I finished all the questions. Oh, is there one more? What kind of business do we set another status? Any business, based on your business. If you're good at the modeling, if you're good at cooking, if you're good at anything, just to set up your small business, and then from that you build up your solo K. Yeah. God give you talent, use it. Okay. For me, I use tax planning. This is my solo K. For you, you might be good at writing a book, or you can good design a website for people. Who knows? Yeah.
Does it have to be profitable?
No, you just have a zero blank solo K setup. Then you start moving money from your old companies, move here. That's fine. You just need a home. That's it. Even the home is empty. Yeah. My son, 23, just started working, still under my husband's medical expenses. Yes, if your husband have high deductible, absolutely. What kind of business? Yeah, you talk about that. Yeah. All right. Just give you a little bit 剧透. I'm running the Family Foundation class every Thursday. People know that. I think Fred, Ted, you guys in my class, right? Can you share a few things? How we learned this? How do you like our class? Ted and Fred and Carl, people.
Well, for me, it's a vehicle to teach your kids financial education and how to have a community awareness, something to share for your family, because you know you have to set up like what are the rules, the bylaws, and what they can spend money on. So it sort of helps make sure that they know they have the proper values.
Yeah, I agree. Family Foundation this is maybe one of the best solutions for. I personally benefit. Every class, my child show up, share his or her experience. You see young people benefit from it. It's good stuff. And then so every Thursday, if you want to sign up, you can scan in the receipt, scan the code, you can show register. So this coming Thursday, meaning 2 days from now, we are going to talk about how to set up foundation. What is step from state level, federal level, what kind of documentation, what kind of, mission statement, record keeping. I'll give you a whole, package. There are 8 documents. I'll give you a template. So if you want to sign up, still have time. Okay. Next week for the other CAPA, Baltimore County, I'm doing this buy, borrow, die strategy. This is probably the rich people's secret. I know that many times, but this is real. This is good stuff. Hold on a second, guys. So that is for next Tuesday. I'm sorry, same time, different Michael. So I found this book is good. This is a very good book. I just read this one called Pay Zero Tax, How Rich People, do you see that? They just use this buy, borrow, die strategy to get it rich and then always stay rich. This strategy works. So next Tuesday, I'm going to spend 1 hour design 10 use cases to share with people. And that's our class. I hope you guys learn a few things from me and from the people, from my friends here. Thank you, Yuan. What else? Well done. Yeah.
All right. Okay. We're going to wrap up, and as a matter of fact, we have already passed the hour. And thank you, Coach Mike, as always. And yeah, just like our Coach Mike said, for those who are interested in the Thursday's class, register, please. And next week, we're going to have another session from Coach Mike. Okay. All right. We are going to close for tonight. Thank you, everyone, for your participation, and thank you, Coach Mike, again. Thank you.
All right. See you guys.
Thank
Thank
you.
you.
Yeah. Bye.